Hello and welcome back. Today's session will be focused on the entrepreneurs, the other side of the table for all the VCs. And what I want to focus on, because I just came out of a class with a fantastic guest speaker on term sheets, I want to focus on anti-dilution and liquidation preference, two of the terms that can potentially really become difficult for entrepreneurs, not tomorrow, not next week, but over time as you're working towards an exit. So let's assume you have agreed with a VC on your valuation of your company. That's the valuation that he will use to invest its capital into your startup. But please remember, valuation is really only the starting point for the discussion when you're raising money for a startup. It really would be a mistake to focus only on valuation when you're comparing term sheets from VCs. Now, what is a term sheet? A term sheet outlines the conditions under which the venture capitalist will invest in your startup. It defines very clearly the preferences, the preferred rights that he is receiving for the money that he's investing in your company. We call that preferred shares. You, as a founder, will hold common shares, and the VC, the investor, will hold preferred shares. Now, let's move on from valuation. Let's focus on one clause in your term sheet that will be there for sure. It's called liquidation preference. Now, what is a liquidation preference? It acts as a protection for the investor in startups. Those investors usually receive preferred shares. There are some VCs out there that take common shares, but let's stick with the majority that take preferred shares. And it protects their investors and themselves in case the company gets acquired or needs to liquidate. And when it comes to liquidation preference, or liq-pref, as some of the VCs call it, details really matter. Now, number one, question to ask is, what is the liquidation preference? Usually it is one time the original investment. What does it mean? If the VC has invested, let's say, $2 million in your startup, and your company is a few years later being acquired by, let's say, another corporate, the VC will receive first its money back. They will receive the $2 million back before anyone else receives anything else. So usually it's a one-time liquidation preference, one time the money invested. Nevertheless, at times we have seen 2 to 5 times liquidation preference. So that VC that invested $2 million in your startup will take 2 times the money off the table first. Only what remains then will be distributed amongst other investors. That's part one. Part two, liquidation preference can be fully participating. And what that means, not only will the VC receive its original money back, he will also participate. Let's say he received 30% of the company for the $2 million that he invested in your startup at the time. He will participate 4 to 30% in the remaining value of the startup. Now, there are liquidation preferences that come without participation, and at times liquidation preferences can also be capped. So there will be a maximum that the VC will receive. Maybe the easiest to have a look at an example. So let's assume you agreed on a term sheet that has a liquidation preference that is fully participating. And let's also assume that the VC bought 50% of your company for $50 million, so $100 million post-money valuation. The company then sells sometimes later, or is being sold sometimes later, for $75 million. So what happens now? With a participating liquidation preference, the VC will receive, step one, $50 million back. That's the $50 million that he invested at the time in you. Plus, he will participate 50% in the remaining value. Remember, you sold the company at $75 million, so out of the remaining 25 million, 50% will go to the VC again. That means out of $75 million that the acquirer pays for the company, 62.5 million will go to the VC. The VC will receive more than 50%, which is its stake in the company. Now, why is that potentially? Some of your entrepreneurs may say like, wow, this is kind of like double dipping. Why does the VC basically have this right? Well, keep in mind, the VC invested in you, let's say 3 or 4 years ago. During that time, you as an entrepreneur received a salary. You were kind of like receiving a benefit in the company. I, as an investor, as a VC, received nothing during that time, but I enabled you with my funding. So when there is an exit, when there is an acquisition, I will first get my money back, which is already a nice, my investors, my LPs will be happy about that. And now I need a return onto my funds being invested. So that's liquidation preference. Second term, and as I said, those are not the only 2 terms you should care about, but I find those 2 are the ones that usually cause a little bit of confusion. Let's go with anti-dilution clause. What is an anti-dilution clause or an anti-dilution provision? Number 1, it is only relevant in a down round. What's a down round? Down round is a fundraising round where you as a startup raise money at a lower valuation than the previous round. So only relevant in a down round. If there never is a down round in your fundraising history, you will not have to deal with anti-dilution provisions. In case there is a down round, as we are right now seeing quite a bit in the market, so what does it do? It offers protection to earlier investors. So if you're raising your round B right now, it protects the round A investors. Because now in a down round, their original investment has lost part of its value. Therefore, those earlier investors will be compensated for their loss in valuation of their stake. How does this work? The target is really here to ensure that earlier investors maintain the value of their shares in the company. How is this being done? Usually you adjust the conversion ratio. Now, what do I mean by that? Remember we said every investor in a startup will ask for preferred shares. Those preferred shares at one point can be converted into common shares, at which point they will lose all their preferences. So when this conversion ratio, which in the beginning will be 1-for-1 quite often, nevertheless, after an anti-dilution provision has been triggered, that conversion ratio would be adjusted from 1-to-1 to potentially 1.3-to-1. So 1 preferred share may give you 1.3 common shares, thereby compensating you for the value that your shares lost due to a down round. Very quick example. Imagine in your round A, you raised $1 million. Pre-money value was $4 million, post-money $5 million. Investors hold 20% of your company. Now you're raising, 24 months later, your round B. You raise $3 million with a pre-money valuation of $4 million. As you can see, your pre-money valuation of round B is lower than post-money valuation of round A. Hence, we're in a down round. So the investor in round A just lost basically 20% of the value of its holdings. So that means the investor needs to be compensated for the percentage value that its ownership of the shares have lost. You will adjust basically the conversion ratio, and that's basically how it goes. Strongly suggest you read up on the additional information that I will be sharing below this video. Thank you so much for joining me. We will continue to share information for entrepreneurs on their way to fundraising heaven, hopefully. If you like the video, please click below, follow me, so you will be notified when the next video is being launched. Thanks very much.